Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on options as an income strategy with the Montreal Exchange. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your toolbar. If you are also experiencing audio difficulties, you can click on that sound check link in your audio panel, and the setup window may show up on your secondary screen if you are using two monitors. As always, everyone is muted for sound quality purposes, and you do get the best experience if you are using, you can actually use telephone or microphone. I'm usually using a script by this time. So yes, you can actually join in by telephone or your speakers, and if you are joining by telephone, don't forget to enter the access code as well as the PIN numbers shown in the audio panel as well. And thank you all for confirming. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. You did get a chance to use that toolbar with a hand icon. I just want to make a note that you can also take advantage of using this arrow icon right here. What that does is really just show or hide the control panel. Sometimes the control panel may cover some of the screen so you're not able to read the content, so feel free to show and hide that, as well as using the full screen mode and the hand icon if you have any questions. And as always, you can always type in your questions in the question panel, and our presenter today will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access past recordings on our webinars demand page under the Learn and Do More section of scotiaitrade.com. You are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. Please note that the link will not show up until the end of the session, and it will show up in the handouts panel as you see here. And today's webinar is part of a learning series that Montreal Exchange offers. Options as an income strategy is part B of series 2, Why Use Options. If you didn't get a chance to view any of the past webinars in this series, you can access them on our webinars on demand page, and also feel free to register for the other webinars coming up in this series as well. And your presenter today is Jason Ayers. He is a Montreal Exchange instructor, and he's been an instructor for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He is a derivative market specialist by designation. Welcome, Jason.
Hey there, Rose. Thanks very much for having me on today, and good afternoon, everybody. I'm just going to show my screen here, and we'll get started with the presentation. So just want to first of all confirm that you can indeed see the title slide for today's presentation, which is Options as an Income Strategy. As Rose demonstrated earlier on, if you could maybe just give me a little high five there to let me know that you're able to see what you're supposed to see, that would be fantastic. Good stuff, and it looks like we're ready to go. So just to sort of echo Rose's disclaimer there, we just want to make sure everybody understands that this information is for educational purposes only. The options market, not unlike any other financial security, can be risky and has risks associated with it. Some limited, others not so limited, depending upon the strategy that you are implementing. So with that in mind, we're really going to focus on the idea of utilizing options as an income strategy, and I think a very, very important consideration, well, for all investors, but more specifically for those of you that are entering into that period of your life where you're going to be drawing on your portfolio to live as you enjoy your retirement years. And so I do believe that more and more options as an income strategy is going to become very, very important in meeting those objectives. So we're going to take a look at the covered call strategy, which is the most common strategy that we would utilize for income generation. I want to compare the idea of buying and holding a security versus the integration of the covered call strategy. We'll do a quick example, and we'll take a look at the platform and demonstrate trade execution. Then we're going to actually compare the covered call strategy to put writing. Ideally, we'll have time to take a look at the platform at that point, and then we'll wrap things up. So let's jump right into it. How do we generate income with options? Well, for most of what we're going to focus on today, it's going to be surrounding the idea of utilizing a call option, and particularly with respect to the covered call strategy. And so we want to recognize that there's two sides to every options transaction. And so when somebody utilizes a call option, let's say as a stock replacement strategy, which is something that we've talked about in previous presentations, really what they're doing is they're paying a premium and they're securing the right to own the shares of a specific security at a specific price over a specific period of time. So that premium that the call option buyer pays goes to a call option writer, and so that call option writer, or seller if you will, accepts that premium and in return takes on an obligation to deliver the shares at a specific price over a specific period of time. So the objective of the call option writer is really to generate cash flow, to collect that premium, and ultimately, benefit from, ideally some stock appreciation, some share appreciation, but also benefit from the, the monthly or every few months the collection of a premium to help increase the cash flow within the portfolio. So we really want to make sure that we remember our contract specifications. One option contract controls 100 shares of the underlying security. So what that means is that if I own 100 shares of a particular stock, well, if it's options eligible, I could sell one option contract on those 100 shares, and it would be considered a covered call. My obligation to deliver the shares represented by the option contract are covered by the 100 shares that I own. So, of course, as we recall from our basics, the price of each option contract is listed in a per share format, and so we multiply the premium by 100 to determine just how much that contract is trading at. And so, for example, if we're looking at a quote of $1.25, well, that's basically suggesting that the option contract is trading at $1.25 per share. The contract represents 100 shares, so the contract itself is worth $125. So what is covered call writing? Well, we're going to buy, or we already own, the underlying shares, and that's a very, very important consideration, because when we're assessing the risk exposure associated with this strategy, we want to recognize that the primary foundation for this particular strategy is ownership in an underlying security. And so we want to recognize that we still hold a risk, which is essentially unidentified, based on the shares that we own, and we're subject, of course, to the the volatility associated with those shares. Now, we can help offset some of that volatility by selling the call option against those shares and taking on an obligation to deliver those shares at a specific price. And of course, that obligation is valid for a specific period of time. Now, we're going to talk about just, why we may choose one strike price over another, or why we choose one expiration month over another, because it really is dependent upon, what we are trying to accomplish. But the main consideration is that our first priority is to make sure that we are, purchasing shares of a company or of an exchange-traded fund that we're comfortable owning. And then from there we can build an option strategy around it. Now, I kind of liken this strategy to you know, the owning a real estate property, and I find that a lot of people understand it a little bit more effectively when we sort of describe it in those terms. So if you think about, you know, when you if you're somebody that's investing in real estate, which, you know, given the markets, a lot of people are these days. You know, if you're investing in an income property, there's a couple of steps around, you know, creating that. That exposure. The first thing you're going to do is you're going to research a, you know, a market or a neighborhood where it looks like there's a good opportunity to invest in. And then once you've discovered that neighborhood, you're going to subsequently find a house within that neighborhood that you know, that looks good and that has a good solid foundation, because, you know, you have an expectation that that house is going to appreciate in value over a period of time. But you don't just stop there and, you know, board the windows and the doors up and just sit back and wait for the real estate market to appreciate. What you would do is you would rent it out. So you would put tenants in that property, and you would subsequently collect cash flow on a monthly basis to, you know, help pay for the mortgage, or you know, help cover any damages that might incur, or do any sort of updates or whatever it is. And then in good times, you know, that of course cash flow is money in your pocket. And so I look at the covered call strategy as a very similar approach, only utilizing stocks. You're looking for a good sector that appears to be, you know, on the upswing. You're going to find a company within that sector that has a good, solid foundation, that the fundamentals, you know, look like they're, you know, that they hold up, and then you're subsequently going to purchase those shares and use the covered call strategy as a way to generate cash flow while you wait for the company shares to appreciate in value. And again, when you're selling those option contracts, those call options, in good time, it's cash flow. And it's working towards lowering your cost basis. In bad times, when there's a little volatility associated with the underlying, it's actually helping to offset some of that volatility, you know, so that you can, you know, you can weather the storm, so to speak. So let's consider the idea of buying and holding versus the covered call right strategy. You know, the standard approach to investing, you know, really has a lot of open-ended questions associated with it. How much money is the stock going to make? How long is it going to take to make that money? If you start losing on the investment, do you sell at a loss, or do you wait for it to come back? You know, in the end, as an investor, you know, using the buy and hold mentality, you're essentially hoping that the investment is going to produce a return, but in the end, you really don't know. Now, there is value in that, particularly if you are looking for yield, because you can, you know, you collect dividends as you're holding the stock. But keep in mind, with the covered call strategy, if you're doing the covered call strategy on a dividend-paying stock, not only are you collecting the dividends, but you're also collecting that additional premium. So you have effectively enhanced your income while you're holding on to that dividend-paying stock. So it becomes a really nice complement to that income objective that you may have. With the covered calls portfolio, you actually know how much cash flow you're going to make, because you know, if you're doing it on a monthly basis or every couple of months, you know that regardless of what happens with that stock share price, you're collecting that premium. So even if the share price fluctuates to a certain extent over the period that you're holding it, you know that you're going to bring in that cash flow into your portfolio. And you also know how long it's going to take for you to make that cash flow. Now, the frequency at which you write those option contracts is going to be dependent upon, you know, perhaps the commissions that you are being charged, because if you're doing it more frequently, it's more commission intensive. It might be your interest in being active versus passive. You know, if you're doing it monthly, you need to be a little bit more active. But nonetheless, you're able to actually you know, essentially create a timeline during which you know how much premium you're going to be taking in. The main thing that you have to prepare yourself for psychologically, which is sometimes a challenge for investors who are always with you know, thinking of that buy low, sell high mentality, is that you really are not overly concerned whether or not the stock goes up or down. Certainly you want to enjoy some capital appreciation as the shares trade higher, but your focus really is capturing that cash flow. You just want to consistently generate cash flow. So when we take a look at this slide here, it's essentially just a generic sort of general comparison of the risk associated with a standard investment versus a risk associated with option writing. And so if we look at it from the standard approach, we want to recognize that if the stock stays the same, goes up a little, or goes up a lot, we would consider ourselves a profitable investor. Now, even if the stock stays the same, it's great, we're going to collect the dividend, but at the end of the day, we can only be profitable in 3 scenarios, really only 2 scenarios, because the dividends we're going to collect regardless. But what happens if the stock stays the same, stock is down a little, or stock is down a lot? We're in fact in a losing position. When we implement the covered call strategy, we can actually maintain profitability under a number of different scenarios. So if the stock is down a little, if we've been consistently collecting cash flow through options writing, well, then that cash flow is going to offset that little bit of a downdraft that we're witnessing in that particular month. If the stock stays the same, but we've been able to collect premium through our cash flow, well, then we have essentially finished that month profitable due to that cash flow through options writing. And of course, if the stock is up a little and the stock is up a lot, not only do we benefit from the share appreciation, but we're also benefiting from the income generated through the call option right. And of course, as I mentioned at the beginning, if the shares are down a lot, well, we have to recognize our main risk is associated with holding the underlying security, and we have to understand that even though we've written premiums against those shares, and even though the premium that we've collected has mitigated some of the downside risk, there still is a risk associated with holding the underlying. So let's look at an example. This is one from a little while back that just kind of demonstrates the effectiveness of the strategy. So back in February, really looking at Inico Eagle AEM as a buying opportunity at that point in time. The shares were trading around $47. So you could buy 500 shares and put up about $23,500 worth of capital. Now remember, the minimum requirement is 100 shares, right? But if we bought 100 shares, then at the time we were able to sell June $50 strike call options for $3.50. So what we were basically doing is collecting $1,750 and taking on the obligation to sell our 500 shares over a 4-month period at $50. Now, anybody that's been following AEM recognizes that at that particular point in time, the shares were trading, I think, around 54 or what have you. But that's fine, because what we were able to do is benefit from some of the upside of the shares, but also collected an immediate 7.5% cash flow for that obligation. What that means is that as soon as we sell that call option, that $3.50 per share, or $1,750, goes directly into our account, and that actually creates a little bit of a buffer for our position. That means that we can essentially weather a 7.5% drawdown in the underlying share price before we're actually at a loss, because the premium that we've collected is offsetting that depreciation in share value. Now, the interesting thing about Inico Eagle at the time, and as the mining sector continues to reflect, is that because of the volatility in that particular sector, we get a high premium, right? And that's something you have to recognize as well. When you are, and this goes back to one of our other lessons on understanding volatility, the higher the option premium, the more likely the stock is going to be volatile. So when you're building this strategy or a portfolio where you want to implement this strategy, recognize that sometimes a high premium is not always the best solution, because usually with that high premium comes significant volatility in the underlying. In this case, you know, it worked well because the volatility happened to be to the upside, but you can see here that just by selling that call option and creating that obligation, we've collected that 7.5% cash flow. Now, here's some consideration. The stock did actually go up quite significantly over that period of time, which meant that on that June 17th, which was the expiration date for that call option that was written, with the shares being up around that $54, $55, we actually were obligated to sell the shares at 50. But between the premium that we were able to collect plus the upside on the underlying share value, we were able to lock in a 14% profit, right? So the challenge is, of course, that you don't get to appreciate anywhere beyond the written strike price. So, you know, the stock at that point went up to the $50 mark, and you can see we still, or sorry, went beyond the $50 mark, but you can still see that we only collected the 14%. The value, of course, is if the stock had done nothing within that time frame, we would have still collected that 7.5%. Even if the stock went down to $45, we'd still be up 3.2%. Now, if the stock dropped all the way down to 42, as an example, we'd actually be only down 3.2%, and the reason being is that the $3.50 premium that we collected for the option contract from selling that option contract offset some of the downside. So the stock-only investor would actually be down 10.6%, while the covered call writer is only down 3.2%. And that's a very important consideration, you know, when you're looking at bigger picture, longer-term investment objectives. If we can mitigate the downside or offset the downside through, you know, some of these option strategies, you know, when the market does drop, we're able to insulate ourselves to a certain extent from that drop, which means when the market finally comes around, we don't have as far to go to get back into profitability. Whereas, you know, again, I mean, you recognize the stock-only investor, you know, would need a 10.6% recovery, whereas the covered call writer would only need a 3.2% recovery to get back to that level of profitability. So very interesting consideration when it comes to mitigating risk. Not completely offsetting risk, that's not what we're doing here with the covered call strategy, but certainly mitigating risk or offsetting risk to a certain extent by utilizing this strategy. So let's consider some scenarios at expiration, because this is a really, really important consideration here. Let's say, for example, you know, you're in the money, which is where we were at with this particular situation in June. Well, the easiest approach is really to look at delivering the stock at the strike price written. So you may be satisfied with the appreciation in the share value. You may be satisfied with the premium that you've collected, and subsequently you're just happy to let that stock go. So, you know, the shares are delivered, so they leave your account and you get paid that difference, and the option expires profitably as it's assigned, and you subsequently keep that premium, and then you can look for a new opportunity, or you could even reinvest in the same stock if you wanted to do so. Now, a lot of times investors don't like this strategy because they love the stock that they're holding. You're not handcuffed to having to deliver the shares, because I know that's a lot of, investors have a lot of anxiety about the possibility that they may have to get rid of their favorite stock. So another way that we could manage that position is that we roll the option contract to a new strike price, or close it before options expiration. So once we buy to cover the written option contract, we no longer have an obligation. We have covered so we sold to open the call option to collect the premium. We then buy back to close the position, and we absolve ourselves of any obligation associated with delivering the underlying shares. So an interesting consideration for, let's say, the previous example there on AEM would be we, buy back the $50 strike call option, and then we turn around and we go out to the maybe January calls, and we go up to the 60 strike, and now all of a sudden we keep the shares, we have all the upside up to $60, plus we've collected some more additional premium to benefit from while we wait for the shares to appreciate. So you're never locked in to the position. You always have a way of managing through that as you move closer to expiration if you don't want to get rid of the stock. Now, the other scenario is if the option is out of the money, which means that the shares are trading below the strike price written, in which case the option expires worthless, you keep the premium, and you continue owning the stock. Right, so there's a couple of different scenarios there that you can consider as you're holding the position, and of course you still need to be monitoring the position, but you do have some choices as to how to manage it as time passes by. So contract selection, it's an important consideration because the one great thing about the options market is the flexibility that it affords us, depending upon what we're trying to accomplish. So. From the perspective of strike price selection, we could in fact sell an in-the-money option. So what that means is, let's say the shares are trading at 50, we could turn around and sell a 45 strike call option. We collect the $5 intrinsic value component of the option contract, plus we capture whatever time value. So that premium may be worth $6, so we collect $5 intrinsic, we collect $1 time. Now, we don't make a lot on that particular transaction, but what we do is we actually build in a very, very significant buffer. So, for example, if the shares drop all the way down to 45, certainly we lose $5 on the share, but we actually pick up $6 on the option contract expiring. So selling in-the-money calls is a way to actually hedge the downside on the stock. If you actually, if you think that the shares have gone as high as they're going to go, maybe you want to use that as a tax deferral strategy if it's outside a registered account. You can sell a deep in the money call option against the shares that you own into the new year, and regardless of how far, within reason, the shares could drop fairly significantly, and ultimately you've locked in your profit into the new year, and then you can take action. And so what it does is it effectively lowers the break-even point on the stock and would be considered a much more conservative approach. Now, at the money is where we're really just mainly focused on generating cash flow, not so much concerned about share appreciation. The at-the-money options are the highest in time value. So what we would do is we would say, okay, we like this stock. We don't think it's really going to do too much over the next month, so let's sell an at-the-money call option and collect as much time as possible. Now, the trade-off there, of course, is that you don't get to participate in any stock upside, which means you have to be comfortable about getting rid of the shares at the strike price you've written, which are going to be close to essentially where you've purchased those shares at. And this is, again, where it's really important for you to wrap your head psychologically around the strategy and ensure that you're comfortable with the idea that you may be giving up those shares within a short period of time, despite the fact that they may have appreciated quite significantly. Now, out-of-the-money options allow us upside on the underlying security. So, if we actually are in a bullish market environment and we believe that there's room for stock appreciation, but we still want to benefit from the income generated through option writing, well, then we can take a look at the stock. We can identify what might be a short-term resistance level for that particular stock, and we can sell a call option at those levels. Now, the trade-off is that we collect a lower premium, because the further out of the money we go with our option writing, the lower the premium we're going to be collecting. But we actually are willing to concede that that amount that we would collect otherwise, because we want to generate it through the appreciation of the underlying shares. So this is something that that you actually would need to, kind of think through in terms of part of your strategy. Now, I got a question here: does the stock need to be in an uptrend before you sell the covered call? Absolutely not. You can essentially sell the call option whenever you feel that it's appropriate to do so, but just recognize that your risk is associated with buying the underlying shares. And so if you've got a stock that is in a precipitous downtrend, just recognize that you're buying a stock in the downtrend, and while selling the call will bring in some premium and lower your cost basis, you really want to make sure you have a good reason for buying that stock. So, short answer is you can sell a call anytime against the shares, but again, you just want to make sure that it's strategic within what you're trying to accomplish. Expiration month selection. So the front month option, which is the option that is expiring nearest term, generates the highest annualized cash flow, but it's more transactional. So, as I mentioned earlier on, if you're somebody that's concerned about commissions and having to pay commissions month in and month out, because not only are we paying commissions to sell the option, but we may also have to pay commissions to deliver the underlying shares. Now, one important consideration is that if you are selling options and they expire worthless, you're only actually paying a commission when you sell the option. When it expires worthless, there are no commissions. It just expires worthless, and there's no transaction that takes place. But you can actually adjust your option writing strategy, again, dependent upon whether or not you're concerned about commissions or whether you just are concerned about being more active. So you can sell further out options, and you'll get actually more premium associated with that, but then you're sort of, you can always adjust the position, but you're theoretically bound for a longer period of time based on that longer term option that you've written or that you've sold. So again, I always circle back to making sure that you are putting some thought into what makes sense for you, and selecting an approach that that best meets your objectives. So there's a number of different objectives that you might be considering. One is short-term trading. So a really interesting way to utilize options or the covered call strategy is, a lot of investors who are, sort of shorter-term active investors, if you will, or traders, they'll look at a stock and they'll think, okay, over the next month or 2 months, I think it's going to hit, it's going to go from $20 to $25. Well, typically what one would do is buy the shares, sit back and wait, and then, watch when the stock hits that level and subsequently sell. But what you could do is, if you know that that's your specific target, you could buy the shares at 20, sell a call at 25, and get paid to wait. And then not only are you benefiting from that short-term upswing, but you're also getting paid to sell your shares at a target where you were willing to sell them anyways, right? So it's a kind of a neat way to generate a little extra pop on a stock that you're looking to trade on a short-term basis. Retirement income, I think, is huge. I think it's going to be one of the most important considerations moving forward for the baby boomer demographic, as the search for yield on a global scale widens. And so the integration of options writing in a portfolio, to me, is going to be irreplaceable. I just really don't know where the cash flow is going to come from, other than just simply drawing on the principal investment. And so it's a great consideration moving forward. Consistent compounding growth. Again, the idea is that you're holding great stocks, you're managing the risk, and every month or a couple of months you're just selling those options and generating that cash flow and then reinvesting and so on and so forth. And from a portfolio management standpoint, the objective of any investor is really trying to generate the best returns with the least amount of risk. Risk-adjusted returns are an extremely important consideration. And so if we can actually mitigate or offset volatility by implementing the covered call strategy, but actually obtain you know, stock market style or even better returns, we're doing ourselves a much better service, I believe. A couple of considerations here, and again, we're going to jump into just doing a quick example in a moment, but a couple of considerations here. Just recognize that the shareholder also receives dividends. So if you build a dividend centric, for lack of a better word, portfolio, and you're collecting 3 to 4% annually in dividends, just recognize that if you can add another 3 to 4% conservatively in option writing, you've just essentially doubled your yield or doubled your cash flow on that portfolio. So it becomes a very, very powerful approach and complement to a dividend-centric portfolio. Now, the only risk is assignment on ex-dividend day. So what will happen is sometimes an astute options trader will recognize that there is less time value in an option contract than what is being paid out by the dividend. And so, you know, with everything considered, that trader may actually exercise their right to take possession of the shares and give up the time premium component, which might be 20 cents, for example, and they'll take the stock and they'll get your dividend for maybe 40 cents. Now, that doesn't happen all the time, but recognize if you hold a dividend-paying stock and it's about to go dividend and you ex-dividend, if you've written a call against it and that call happens to be at or in the money, it may get, stock may get called away from you. You will get paid you know, the amount that the strike price is set at, and you will get to keep the option premium, but unfortunately you will not get the dividend. To me, it's worth noting, but not something to lose sleep over necessarily. And if you're concerned about that, you can always roll the option contract up and out to another strike price and expiration month to avoid that as being an issue. We also want to make sure that we're comfortable with the difference between cash flow versus returns. When we talk about cash flow, it's the total premium collected, right? So we don't consider capital gains or losses. We don't consider dividends. We simply look at how much cash flow is being generated through options writing. When we are looking at the word return, returns reflect capital gain or loss plus premium plus dividends, and returns will vary depending upon the market environment that we're in. So before we jump into covered call versus put writing, let's just take a quick look at the platform here, and I just wanted to do a quick example of how we might implement a covered call strategy. So I'm just going to just go over to equities here, and let's say, for example, I'm looking at Magna here on the Canadian side. So let's assume we don't hold Magna within our portfolio, and Magna's trading around $54.41. And we see value in holding Magna as a company, but we also want to try to generate a little bit of cash flow off of that. You know, there's a 2.4% dividend yield, not all that impressive, but it's still something that's there. And so the first thing that we want to do is we're going to buy these shares. And so here I just want to make sure we're doing this in the practice account. So we're going to buy these shares, and we're just going to buy 100 shares of the underlying security. In this case, we're going to go at the market, which means we're prepared to pay. In this case, the ask is $54.34, so we're going to pay $54.34. Now, the reason why I chose 100 is because that's the minimum number of shares we need to hold in order to sell a covered call. And so here I just need to pop in the access code briefly. Shouldn't take me very long here. And so let's just see. Now we're going to submit the order. And I think everything is going to go through here. So let's now just take a look. We're going to view this order. And it looks like it it was filled. And so I'm going to turn around. I'm just going to take a look at my account first of all here, just to see where those shares are sitting within that portfolio. And bear with me 1 second. Okay, so here's our Magna sitting in there. We've got 100 shares. So we just purchased those shares. Now what we want to do is we want to go to the options market. So we're going to circle back to quotes and research. We're going to once again access well, you know, we're going to jump right into the options market here. I'm going to type in the symbol. And so in this case, we're looking at options that are expiring October 21st, so just under a month until expiration. And so I'm looking here at the 56 strike call options. And so what I'm prepared to do is I'm prepared to say, okay, I think Magna's going to chop around a little bit for the next month. It's currently sitting at $54.40. I could make $1.60 per share on the upside, plus I could pull in a 45 cents by selling these calls at the bid price. If that to me or to you makes sense from an investment perspective, we're not quite making 1% on the option, right? But we're not quite doing that over the course of a full month either. So, you know, the percentage rate of return or the analyzed rate of return on 45 cents over a 1-year period is not unattractive as far as my mind is concerned. And so what I'm going to do is I'm going to turn around here and I'm going to click the trade button. And you can see all of the information is now populated. Once again, want to make sure that I'm executing it appropriately in the appropriate account. We'll make this a sell to open covered. It's going to be one contract. And we'll go at the, well, it's going to make me do a market, so we'll do market, and I'm going to have to go for 45 cents. And in this case, we'll make it a day order. So ideally, because I'm going in at the bid price, this little sample order will get filled very quickly. So we're going to run through this, and we're going to submit the practice order. It's been placed. Let's just take a look at the order. Let's see if it's been, so that was filled pretty quickly because we went in at the market. So we're going to take a look at our account, account details, make sure we're looking at the proper accounts. And so now we have our Magna shares here at 100 shares, and we have short one contract. Now, it's really important for you as the investor to get comfortable with how this looks within your portfolio, because at the end of the day, the options are going to move, the shares are going to move, things are going to happen, and you're going to see some red every now and again. But understand that the risk on this position is based on the underlying share value. You've lowered your cost basis essentially since we paid $54.35. You've actually lowered your cost basis down to $53.90. So really what this means is that you've got a position here together that you would look to ideally see through till expiration, but if need be, you can manage each position independently. So let's say, for example, Magna started selling significantly, you'd be able to buy back the call option cheaper and sell the shares, get out of the position. So that was sort of what I really wanted you guys to be aware of, is that each position is held independently within your account, and you can manage each position separately in order to manage risk or adjust the position according to what you're trying to accomplish. So let's take a look, just to wrap things up, at the idea of comparing the covered call strategy to put writing. So just a quick review of put writing in general. This is where we don't own the underlying shares, but what we're doing is we're getting paid a premium up front for taking on the obligation to purchase the underlying shares. So remember, as the put buyer, we pay a premium to sell the shares. As the put writer, we actually get paid a premium to take on the obligation to buy the shares at a specific price within a specific period of time. So the other example here that I wanted to look at is just one on XGD, and it was back in March. XGD, of course, that ETF portfolio, or sorry, gold index ETF, and at the time was trading at $12. And really an important consideration with this comparison is that for both the covered call and the put right, the risk is exactly the same. So the risk-reward profile for the covered call and the put, naked put or cash-secured put, is the same. So we could actually, if we were looking to implement the covered call, we could buy 1,000 shares of the underlying ETF and pay out $12,000. We could then turn around and sell 10 3-month covered calls at the $12 strike and collect 90 cents or $900 per share. Alternatively, we could leave the cash sitting in our account and sell 10 3-month $12 strike puts and collect 90 cents per share or $900. So what happens is that if the shares are trading above $12 on expiration, the call is exercised, the shares are sold at $12, and there's a net profit of $900. From the put writer's perspective, the put will expire profitably out of the money, because as long as the shares are trading above the $12 strike put, there's no obligation, so no shares are ever transacted. But the put option expires, and because we collected 90 cents or $900, that becomes our profit for the position. Now, if the shares are trading below $12, well, in the case of the covered call writer, the call will profitably expire. The shares remain in the account. There's a net realized cash flow of 90 cents, and you can adjust your cost base, or your cost base is adjusted down to $11.10. From the perspective of the put writer, the put is exercised. You have to buy 1,000 shares at 12, so now you're a shareholder at $12, but there's a net realized cash flow of 90 cents. You now own 1,000 shares at $12, but because you've collected 90 cents through the put right, your average cost base is $11.10. So you can see that there is really no difference between being that at the money covered call writer or being that at the money put writer, right? It's just a different way to enter into the transaction. And just to, so one of the interesting considerations, you know, when looking at being a put writer, now it's important to understand that you can't do this within your within a registered account, but you can do it outside of a registered account. Is, let's actually say for a moment that you know, we actually don't own Magna. But we're thinking that we may want to own it in the future. So we could take a look at, actually hold on just 1 second here. Just make sure we get the close. So there's Magna here. So once again, we're maybe thinking that $54.34 is a little high, but we're saying at some point we want to own these shares. We can go to the options market and we could say, okay, well, I can sell a $54 strike put, and I'm going to collect 91 cents. Okay, so what that means is that if the shares are trading above $54, that 54 strike put option will expire worthless, and I will keep that premium. If the shares drop down to 54 or below, I'm obligated to buy the shares at 54, right? But I get to keep that 91 cents. So if we think about it, we're getting paid to wait for the stock to drop to a price point that we are comfortable owning it at. If we get assigned to buy the shares, in this case at 54, our average cost base becomes $53.10. So now we own the shares at $53.10. We could turn around and start implementing the covered call strategy and generating cash flow through that approach. So that put option strategy, again, in a non-registered account, becomes a really, really interesting way to get paid to wait for a stock to come to a price that you are comfortable owning it at. So you could look at, a price chart, and you could identify a short-term technical support level, and that might be where you choose to sell the put option because that's where you feel it's appropriate to own the underlying shares. Now, I'm not sure if I'll be able to execute this as a trade within this demo portfolio, but just to kind of take you through the steps, if we're going to sell to open, so it's not going to, in this case, it's not going to let me, but what we would be doing is, we're going to sell to open covered. It would be a cash covered put. We could do one contract. And we could go limit, and we're going to do 95 cents. So basically what we're saying is I want to collect, well, it looks like the bid's 92. So we're going to do one contract, which obligates us to buy 100 shares of Magna at $54 if the shares drop down to or below that level. So we'll see if we can actually transact this, and I'll show you. Yeah, so we would need to have special permission in this particular account in order to execute that. But you guys get the idea behind the strategy. Very, very powerful. Again, unfortunately, not permitted within a registered portfolio. So, guys, in conclusion, by implementing an option writing strategy, we can actually reduce volatility in our portfolio and be more consistent in earning income beyond the traditional approach, such as dividends. Quite often, covered call writing is stereotyped as being risky, but in fact, it's a relatively conservative strategy because, the risk is associated with the underlying shares, but we're mitigating that risk to a certain extent, again, through that consistent option writing and the collection of cash flow. Covered call writing can be executed in a registered account, so RSP, TFSA, etc., RESP, LIRA, all that sort of fun stuff. But put writing is only available in margin accounts. So on that note, guys, as always, lots of information on the Montreal Exchange website, blogs, newsletters, videos, trading guides, calculators, trading simulator. As well, of course, there's a really great collection of archived videos and such on the iTrade site as well. So, with that in mind, I'll pass it back to Rose, and we can take any questions that folks may have.
Jason, there was one question that came up from James. He asked, does the stock need to be in an uptrend before you sell the covered call?
Yeah, I actually did answer that during the presentation, but just to sort of reiterate that response, you can absolutely sell a call option against the stock at any point, regardless of how it's trending. What I wanted to make sure everybody understood is that your risk lies with the stock position. So you want to be making your investment decisions based on the the value that you see in holding the stock, not the amount of premium that you get to collect through selling the call option. You don't want to find a call option to sell and then subsequently the stock is a second thought. You want to do it the other way. Choose your stock first. And then think of it this way: if you own an income property, you don't find tenants first before you find the right property. You find the right property first, and then you find the tenants, and that's how you want to think about the covered call strategy.
Thanks, Jason. So I'm going to bring some closing remarks while you guys type in your questions, and Jason can adjust them afterwards as well. So you can access webinar recordings on our website from next week on, and also don't forget to fill out the short survey that will pop up after you exit today's session. It really just allows us to customize our educational offerings to you so that we can better meet your needs. Also mark your calendars. On Thursday, October 6th, we also have a webinar on how to get started with Scotia iTrade. And Montreal Exchange joins us again on Tuesday, October 25th at 1 p.m. Eastern Time to present on options trading using technical analysis. And also for the first time, we are offering a fireside chat with Evelyn Jacks. The topic is managing risk to your wealth. It's not available yet, it is coming soon, but please check our webinar calendar to register. And it's on October 19th at 1 p.m. Eastern Time. What's happening in the fireside chat is really a live video stream, and you're able to submit your questions, so it's more of a conversational format as opposed to our regular webinar presentation. And topics that she will be covering is how to make better financial decisions through economic uncertainty, as well as tax trends, opportunities in retirement planning, as well as how to manage assets and multi-generational wealth transfer. And also another offering for the first time ever, we have our online investor bootcamp. What this is 4 hours a week for 4-week sessions. So there is a tutorial, a lesson on Tuesdays, and office hours on Thursdays where you're able to ask any follow-up questions from the lesson. And this 4-week session, the first week covers stock selection, week 2 is entry and exit strategies, and week 3 is risk management, and 4 is bull and bear market ETF strategies. And you can register for that on the Scotia iTrade U Bootcamp page under the Learn and Do More section as well. And also you can register for other webinar offerings on our seminar and webinar calendar located under the Learn and Do More section. And again, past recordings on the Webinars on Demand page. And with that, I want to thank Jason for sharing his insights, and thank you all for joining us today. I've also made the handout available for you to download in the handouts panel. And if there are no questions, have a great day, everyone. And you can always send your questions in to education@scotiaitrade.com. Thanks, everyone, and have a great day.
Thanks very much.